Most people think buying a house is the moment they become financially stable. But for millions of homeowners, the exact opposite happens. The mortgage becomes the thing, quietly draining every future dollar they haven't earned yet. Because the truth is, banks are not trying to figure out whether your life will feel secure after you buy a home. They are trying to figure out whether the payments will clear every month. And those are two completely different calculations. The dangerous part is that the approval number feels official. It feels safe. If the bank approved you, then surely you can afford it, right? But what if the number they approved is the exact number that guarantees you stay financially stuck for the next 30 years? Today, we're going to break down the real cost of home ownership in 2026, using 3 different incomes: $70,000, $120,000, and $220,000. We'll look at what the bank says they can afford, what traditional financial rules say they should buy, and what their actual lives look like after they move in. And by the end, you'll understand why so many homeowners look wealthy on paper while secretly living paycheck to paycheck behind the front door they worked so hard to buy. Because here's the part nobody explains before you sign the papers. A mortgage payment is not your housing cost. It's just the beginning of it. The bank calculates one number: principal and interest. Maybe taxes and insurance if they're being slightly more realistic. But your real financial life doesn't stop at the loan payment. Houses consume cash in ways renters don't fully understand until they own one. The air conditioning fails in July. The roof starts leaking during a storm. Property taxes jump because the city reassessed your neighborhood after prices exploded. Insurance premiums rise because climate risk changed in your state. And suddenly the affordable payment the bank approved becomes the smallest part of the problem. In 2026, homeowners insurance in many states has increased over 30%. Compared to just a few years ago, property taxes are climbing alongside home values. Repair costs are inflated because labor and material prices never fully came back down after the supply chain chaos of the early 2020s, and yet approval standards still pretend most of this doesn't exist. There's another cost almost nobody measures correctly: flexibility. The moment you buy an expensive house, your life becomes less mobile. You stay in jobs longer because the mortgage depends on stability. You avoid career risks because uncertainty becomes dangerous. You stop investing aggressively because cash flow tightens. The house becomes an anchor, not always in a good way. And banks love stable borrowers. They love predictable income. They love people whose biggest priority every month is protecting the payment. That's why the approval process isn't built around maximizing your wealth. It's built around minimizing their risk. If you can technically survive the payment, the system works exactly as intended. So let's start with the first beer. Meet Alex. Alex earns $70,000 a year. He's careful with money, doesn't carry huge debt, has saved 4 years because he's tired of watching rent increase every single renewal cycle. He wants a house because everyone around him keeps saying the same thing. Renting is throwing money away. Under the traditional 28-36 rule, Alex should spend no more than 28% of his gross monthly income on housing. That gives him a target payment of about $1,633 a month. At current 30-year mortgage rates, around 6.5% with 10% down. That translates into a home around $220,000. The problem is that in many cities, $220,000 barely buys anything anymore, especially not in areas with stable jobs and low crime. So Alex stretches, just slightly. He tells himself he buys a $310,000 home because compared to national median prices, it still feels reasonable. Now watch what happens to the math after closing day. His loan amount after 10% down is about $279,000. Principal and interest alone come out near $1,764 per month. Property taxes add another $285. Insurance adds $150. PMI, because he didn't put 20% down, adds another $180. His actual monthly housing cost is now around $2,379 every month. That's over 40% of his gross income before utilities, internet, repairs, lawn maintenance, or HOA fees if applicable. After taxes, Alex brings home roughly $4,500 a month. Once housing is paid, he has barely over $2,100 left. Gas, groceries, healthcare, phone bill, car insurance, student loans, occasional emergencies, everything comes from that remainder. There's almost no room left to invest. Retirement contributions slow down. Emergency savings stop growing. One major repair pushes him into debt immediately. But from the outside, Alex looks successful now. He owns property. He has a driveway. He has equity. And quietly, financially, he's suffocating. What makes this worse is the psychology of ownership. Once people buy a home, spending tends to increase automatically. Suddenly, there's furniture to buy, appliances to upgrade, repairs that can't wait, decorations, landscaping, security systems. Home ownership creates a constant stream of necessary expenses that didn't exist before. Studies consistently show that the first 2 years after buying a house are often the most financially stressful period for middle-income homeowners because cash reserves disappear faster than expected. Alex thought the hard part was saving the down payment. In reality, the down payment was the easy part. Now meet Sophia. She earns $120,000 a year. Solid career, good credit, no major debt besides a modest car payment. She's exactly the kind of borrower banks love because statistically, she's reliable. Under conservative financial guidelines, Sophia should target a home somewhere around 3 times her annual income, roughly $360,000. But the market she lives in moved much faster than salaries did. Homes that sold for $350,000 minus 1 year ago now list near $550,000. Her bank sees her strong income and approves her for over $650,000. The loan officer phrases it carefully. You have a lot of room here. That sentence changes people psychologically. Approval feels like permission. If the bank says you can afford it, then maybe spending more isn't irresponsible after all. Sophia buys a $525,000 home with 15% down because waiting another few years to save 20% feels impossible while prices keep climbing. Her mortgage balance lands near $446,000 at current rates. Principal and interest are about $2,820 monthly. Property taxes add $520. Insurance adds $170. PMI adds another $190. Because she missed the 20% threshold, total monthly housing cost around $3,700 on paper. That's manageable for her income. But look at what happens after real life enters the equation. Her take-home pay after taxes and retirement deductions is roughly $7,000 a month. Housing wipes out more than half immediately. Then come groceries, transportation, utilities, health expenses, subscriptions, social life, travel, gifts, and inflation everywhere else. Suddenly Sophia realizes something strange. She earns 6 figures, but still feels financially tight all the time. This is where lifestyle inflation and housing inflation collide. High earners often assume future raises will solve the pressure, but raises rarely outpace the combined growth of taxes, insurance, maintenance, childcare if it arrives later, and the invisible costs of adulthood. Sophia thought she was buying stability. Instead, she bought a fixed obligation that consumes future flexibility. She can still survive. Technically, the mortgage is affordable, but wealth creation slows dramatically because so much income is now trapped inside the house. Her investment accounts grow slower. She delays maxing retirement contributions. Vacations create guilt. Job changes feel riskier. The house slowly dictates her financial behavior. And then something even more dangerous happens. Home prices rise further around her neighborhood. Everyone around her starts talking about equity growth like it's guaranteed wealth. People begin treating their homes like investment accounts instead of places to live. This creates one of the biggest financial illusions in modern society. Home equity feels rich, but it's mostly trapped wealth unless you sell, refinance, or borrow against it. And borrowing against depreciating assets is exactly how people accidentally turn houses into debt machines. A kitchen renovation here, a HELOC there, new floors because everyone else upgraded theirs. Slowly, the asset designed to create stability becomes the reason financial stress never disappears. Now let's look at Marcus. Marcus earns $220,000 a year. On paper, he's wealthy. Strong career, consistent investing habits, no consumer debt. If anyone should be safe buying a house in 2026, it's him. Traditional affordability rules suggest a home around $650,000 to $700,000 would keep him comfortably within healthy ratios. But Marcus lives in a high-demand city where ordinary family homes regularly cost $900,000 to over $1 million. And this is where even high incomes begin breaking under modern housing economics. Because expensive housing markets don't just require bigger payments, they require enormous cash positions. Marcus buys a $950,000 house with 20% down. That's $190,000 gone immediately before closing costs, moving expenses, furnishing, or reserves. His mortgage balance lands near $760,000. Principal and interest at current rates run about $4,800 monthly. Property taxes in his area are close to 2%, adding another $1,580 per month. Insurance adds $240. Maintenance, reserve on a house approaching $1 million realistically, needs to average at least $800 monthly over time. Expenses don't occur evenly. His real monthly ownership cost is now over $7,400, even at his income. That changes everything. After taxes and retirement contributions, Marcus takes home roughly $11,500 monthly. Housing alone absorbs almost 2/3 of it. This is the part middle-income buyers rarely see. High earners don't escape housing pressure anymore. They simply experience it at a higher dollar amount. Marcus still has money left every month, but the psychological pressure changes because his financial burn rate exploded. Losing his job now carries dramatically different consequences. The emergency fund requirement becomes massive. Lifestyle expectations rise around him because of the neighborhood he bought into. And the opportunity cost of that, $190,000. Down payment matters more than most people realize. At a 7% annual return, that money alone could potentially double over roughly 10 years invested in the market. Again, this doesn't mean buying a home is automatically wrong. It means the real cost is larger than the mortgage calculator shows. This is why the housing conversation in 2026 feels broken. Previous generations often bought homes when prices relative to income were dramatically lower. A single income could often support ownership. Property taxes consumed a smaller share of earnings. Insurance was cheaper. Interest rates during key periods were lower. But modern buyers are trying to force old financial rules into a completely different economic reality. And because people emotionally associate home ownership with adulthood, success, and stability, they stretch further than they should. Nobody wants to feel left behind. Nobody wants to believe they missed a housing ladder permanently. So they rationalize payments that quietly erase their ability to build wealth elsewhere. The bank does not calculate this. The bank does not ask whether you're investing enough for retirement after the mortgage clears. They do not ask whether you'll still have flexibility if childcare enters your life, or if aging parents eventually need support, or if layoffs hit your industry. Their system measures default probability, not long-term financial freedom. Those are not the same thing. You can successfully make mortgage payments for 30 years and still fail financially, because the payment consumed every wealth-building opportunity along the way. So what number actually matters? It's not the approval number. It's not even the purchase price. The real number is what remains after all. housing costs are paid, and whether that remainder still allows you to build wealth consistently. Think of it as your financial breathing room. After the mortgage, taxes, insurance, maintenance, utilities, and realistic life expenses, can you still invest aggressively? Can you still handle emergencies without debt? Can you survive temporary income loss? Can you continue building optionality into your future? Because optionality is real wealth. The ability to make decisions without financial panic. The ability to leave bad jobs. The ability to take risks. The ability to retire before your body forces you to. A lot of people buy houses that impress others, but quietly destroy optionality. And because housing is emotional, they defend the decision publicly even while feeling trapped privately. They tell themselves the house is an investment. Sometimes it is, but an asset that prevents you from investing elsewhere, creates constant stress, and leaves you cash poor is not automatically building freedom. Sometimes it's just expensive ownership disguised as success. Here's the uncomfortable reality. In many markets today, the financially smartest house is smaller than the one people want. Less impressive, less updated, maybe farther from the city center, maybe not the dream home. But sustainable housing creates something powerful that overstretched housing destroys. Margin is what allows wealth to compound. Margin is what protects you during recessions. Margin is what keeps a broken roof from becoming a financial disaster. Margin is what lets you invest during market crashes while everyone else is panicking about bills. And this is exactly why so many financially disciplined people now delay buying. Not because they hate home ownership, because they understand the math. A house purchase too aggressively can delay financial independence longer than renting strategically ever would, especially when high interest rates amplify every dollar borrowed. In 2026, the difference between a manageable mortgage and an overwhelming one often comes down to ego. Buying the house you can technically qualify for versus buying the house that still leaves room for your future self to breathe. The safest buyers are not necessarily the ones with the biggest incomes. They're the ones with the largest wealth building margin after housing costs. The people whose investments continue growing. The people who maintain emergency reserves. The people who avoid turning every rise in home equity into an excuse for more debt. The people who understand that being house rich and cash poor is still financially fragile. So before you buy, calculate your real number, not the bank's number. Your number. Include maintenance. Include taxes rising over time. Include insurance increases. Include the possibility that life becomes more expensive later, not cheaper. And then ask one question. After all of it, can you still consistently build wealth? Because if the answer is no, then the house is not creating financial security. It's consuming it. Banks will continue approving people for payments that maximize borrowing capacity because that's how the system works. Real financial freedom requires a different calculation entirely, one based not on surviving the payment, but on protecting your future while making it. That's the difference between owning a home and being owned by one.